Hi, can you hear me? Students, can you hear me? Can you confirm? Okay. Okay. So I welcome you all in the class. So as you know that we are working on question number one of the paper. In yesterday class, we have worked on consolidated profit and loss and one question on consolidated statement of financial position. So we will continue that practice. And today, again, I'm starting from the practice question. And this question is relating to a foreign subsidiary, consolidation of the foreign subsidiary. The question name is Hummings Uh, Hummings uses the dollar as its functional currency. It acquired 80% equity share of the C company on 1st January X4, and the group financial year end is 31st December X4. The exhibits, we have five here. One is on functional currency. Uh, Other one define the purchase of the C company. Then we have impairment of bond, further information, and draft consolidated statement of financial position. So first of all, the exhibits, and the first exhibit is on foreign currency. Head office of the C company is located in a country which uses the dinar as its main currency. However, its staff are located in a variety of locations. Consequently, half of their employees are paid in dinar and other half are paid in the currency of grommets. C company has a high degree of autonomy and is not reliant on finance from H company Hummings Co, nor do sales to Humming Co make up a significant proportion of their income. All of its sales and purchase are invoiced in grommets, and therefore the C company raised most of the finance in grommets. Cash receipts are retained in both grommets and dinar, and C company does not own the bank dollar account. C company required by law to pay income tax on its profit in terms of dinar. This is the exhibit number one. And if we look at the requirement, using exhibit one, explain how the functional currency of the C should be determined. How the functional currency of the subsidiary should have been determined. Dear student, if we talk about the functional currency, it's the currency of primary economic environment in which an entity operates. Primary economic environment in which entity operates, currency of that economic environment is known as functional currency. And to determine the economic environment, we have primary and secondary indicators which we use to determine the currency of economic environment. Uh, the first primary factor to determine the functional currency is the currency of sale price, and the second primary factor is the currency of operating economic currency of operating expenses, the currency in which significant portion of uh, operating expenses is being paid. Then there are secondary factors as well. Secondary factors include the currency of financing and currency of retained earnings. These are the guidelines regarding the functional currency. Okay. Now, if we apply these guidelines on the determination of the foreign currency of the C company, there we need to take further considerations as well. Dear student, the C company is a foreign operation. Now, according to ICE 21, if we have a foreign operation, first of all, the first step is we need to determine that whether the functional currency of the parent company, the functional currency of the investor company, may be the functional currency of the foreign operation. Like here, Hammond Company functional currency is US dollar. The first thing we need to consider here that whether we can say, whether we can conclude that the functional currency of the Hamming company, the parent company, is the functional currency of the C company foreign operations subsidiary. Now, in order to evaluate that thing, we have to see that whether the foreign operation is an autonomous company taking their own decisions with complete autonomy, or whether they are just an extension of the parent company. If they are extension of the parent company, they are not autonomous company. They are heavily dependent on the parent company for their needs, like for their financing needs. In that case, our conclusion, our analysis would be that the functional currency of the Hamming company will be the functional currency of the C company, if this is the case, and that would be dollar. But here, however, but here it is not possible. Because if you read the question, it is mentioned that the C company has a high degree of autonomy. It's not reliant on finance from H company, nor the sales between the Hamming company and the C company are significant value. So, considering all these things, it is quite clear that the C company is not an extension of the Hamming company. That is an autonomous company. So in that case, the functional currency of the Hamming cannot be the functional currency of the foreign operation, the C company. Now, after the evaluation of this point, now we need to determine, okay, if the dollar is not the functional currency of the C company, then what is the functional currency? In that case, you need to evaluate all these things. Currency of sale price, currency of operating expenditure, secondary currency of financing, and currency of retainer. Now, if you read the question, the operating cost, like employee salaries, half of the employee salaries they paid in dinar and half they paid in grommets. However, as far as the sale and purchase invoices are concerned, especially the sale invoice is always in grommets. So sale is recorded, invoice is generated in grommets. We do sale in grommet currency. And if the grommet need the finance, if the C company need a finance, they raise the finance in grommets. Cash receipt both pertain both in grommets and dollars. So evaluating these things, the majority of the factors are suggesting that the grommets should be the functional currency of the C company, not dinar, not dollar. Grommet should be the functional currency. You got it? Kindly read the answer. So first of all, they are defining the functional currency, and then with the foreign acquisition, foreign operation, they are considering that whether the humming currency could be the functional currency of the C, the subsidiary, and in that, in order to that, the subsidiary company should have a dependency on a parent company. Okay, like it should not be autonomous company. Um, they may be dependent for financing need on their parent company. But here in this case, no such thing. So we conclude that dollar is not the functional currency. So if dollar is not the functional currency, then what is the functional currency, whether it is dinar or grommets? So you know that sale invoice generated in grommets only. All other expenses are in grommets and dinar, but the sale is the thing which in a primary factor which is generated only in terms of grommets. And majority of the operational expenditure and financing is also raised in grommets. So uh, we will conclude at the end that the grommet should be treated as the functional currency of the C company, of the subsidiary company. You got it? Any question? Any questions, student? Now, the second requirement in a part B. Part B, using Exhibit 2, discuss how the C company customer contract should be accounted for in a consolidated financial statement of the H company, which are presented in dollar. Now, the C company functional currency is grommets, but the group presentation currency is dollar. So, how should customer contract should be accounted for in a consolidated financial statement? Dear students, kindly read the exhibit number 2. Kindly read this exhibit. So H company paid cash $24 million for 80% holding of the C company on 1st January X4. H company has a policy of measuring the NCI at fair value, and the fair value of the NCI at 1st January X4 was $6 million. Since the C company has a range of net assets held domestically and overseas, the fair value of the net asset at acquisition date were determined in their local currency, Hence, the fair value of some asset have been determined in dinar and other in grommets. The total fair value of the net asset in denominated in grommet on 1st January X4 is 43 grommets and 50 million in dinar. Excluded from these fair value, the several contracts with the customer of C company that have not been recognized in C company's separate financial statement. These contractual relationships prohibit the customer of the C company from obtaining services from any of the main competitors of the C company. They have estimated fair value on 1st January X4 at 15 million grommets and are expected to provide benefit for an average period of 3 years. And the goodwill is impaired by 30%. And following are the exchange rate on the date of acquisition at the year end and average rate we have been given. Now, requirement in the part B, first requirement is how should we account for this contract with customer? Now, dear student, as we have studied that as per IFRS 3, business combination, all assets and liabilities should be determined at fair value at the date of acquisition. Now, the subsidiary company has an intangible asset which is not recognized by them because that was internally generated and that is not identifiable, not separable. But according to IFRS 3, if the subsidiary company has some intangible assets and at the date of acquisition they become identifiable, they must be measured at fair value in a group account. They must be measured at fair value at the group account and should be amortized over the remaining term. So in simple words, this contract with customer, should be accounted for at fair value on 1st January X4. And on 1st January X4, the fair value of the, if I can show you the calculation here, the fair value in grommets is 15 million US dollar and the depreciation is over 3 years. So the closing value in terms of grommets of this customer relationship is $10,000. Okay. But now it is in grommets, we have to translate it in the dollar terms, and for exchange purposes, the net asset at the date of acquisition will be translated using the rate at the date of acquisition, which is 8 grommets per dollar. So in terms of dollar, it is 1875. And the depreciation is an accounting expense and it will be translated using the average rate, and the closing value of the net asset will be translated the exchange rate at the closing date, which is 7. So in terms of dollar, these are the movements. But the most important thing, now the opening value of the customer list translated using the historical exchange rate at the date of acquisition, depreciation expense translated using the average rate, and closing value of the asset translated using the closing rate. Now average rate and the closing rate at December X7 both are same. Now, after doing all these things, there will be a balancing value, which is 1875. Just let me 268. Now, this 268 is the exchange gain and loss, and it should be reported in the group financial statement with the percentage owned by the group, and that according to that percentage it will be recorded in group reserve, and the remaining will be the share of the NCI. So the customer contract should be measured at fair value at the date of acquisition, and it should be depreciated over the remaining useful life. Just a minute. Let me check the rate. Okay, just a minute. Average rate is 7.4. Just a minute. Average rate is 7.4, not 7. So 229 would be the exchange rate. Okay, average rate is 7.4. Depreciation expense, item of profit and loss are translated using average rate, and closing value of the net asset translated using the closing rate. So this 229 may need to be reported, but this is how it should be accounted for. Now, let me show you the answer. So till here we have the answer. Kindly read the answer. Kindly read the answer that how the customer list at the date of action should be accounted for in the group financial statement and subsequently. Okay, have you read it? So according to IFRS 3, with the reference of, they are discussing with the reference of IFRS 3, uh, all the assets and the liabilities of the investing company should be measured at fair value at the date of acquisition. And to be in case of intangible asset, if the subsidiary company has the intangible asset and they haven't recognized it because it was not identifiable for them, in case of consolidation, group accounts, that asset might become identifiable with the group perspective, and in that case, you should recognize it at fair value. At fair value. So the fair value at the date of acquisition was grommets, 15 million grommets, and on the date of acquisition exchange it was 8. They are just explaining the now calculations, and the in terms of dollar it become 1875. In 3 years it will be depreciated 5,000, translated using average rate 676, and the closing carrying value translated using closing rate, and 230 is the exchange gain, which need to be recorded in other comprehensive income, and it would be distributed between among the group and NCI. Similarly, the depreciation expense should also be distributed between group and NCI. Now, the next requirement on the same question is to calculate goodwill on acquisition of the C company grommets and explain how it should be accounted for in a consolidated financial position of the H company at December X4 after translation. Your answer should include a brief explanation of how the impairment and the exchange differences on a goodwill will impact on the consolidated financial statement. So now we have to calculate the goodwill at the date of acquisition and at the year end. Now, for that purpose, again, we will be using the exhibit number 2, and here we have the working of goodwill. Now, investment in the C company in terms of dollar is 24, but it will be translated using the rate at the date of acquisition. So in terms of dollar, it was 192. And the fair value of the NCI was 6 million, and exchange rate is 8. So in terms of grommet, it was 48. Now you need to minus the fair value of the net asset and the date of acquisition, 240, and here it will be 30, translated using the rate at the date of acquisition. Now the fair value of the net asset at the date of acquisition. Some assets are in grommets, which are 43. So equal 43 plus 50 million in terms of dinar. Now the assets in dinar would need to be translated using the rate at the date of acquisition, which is 2 grommets 1 dinar. 2 grommets, 1 dinar. So you need to apply it by 2. So it will become 143. But in terms of dollar, they will be translated using the rate at the date of acquisition in dollars. It will be translated in dollars using the exchange rate at the date of acquisition, which is 8. And now the goodwill, in terms of grommet, it is 143. And in terms of dollars, it is 12.125. 12.125. Now, the goodwill is also impaired by 30%, which is 29.1. As mentioned in our question, at year end, the goodwill is impaired by 30% at the year end. So they will be translated using the exchange rate at the year end. So in terms of dollar, it is impaired by 4.157. So goodwill in terms of grommets at the year end is 67.9. But according to the IS 21, goodwill should be translated using the closing exchange rate. So it will be translated at 7, which become 9.7. But just a minute, one more thing which we need to consider here is the 15,000 fair value adjustment. 15,000 fair value adjustment. That thing need to be considered here. So 15,000 we are taking 30 common. So the goodwill will be 182. In the fair value of the net asset, 43 grommets, 50 dinar translated at the exchange rate of 2 dinar is equal to 1 grommet. 2 grommet is equal to 1 dinar, and 50 million is the fair value adjustment relating to customer contract. So total fair value, the net asset will be 158. So following would be the goodwill. Now, this is the value of the goodwill, 57.4, translated using the closing rate. Translated using the closing rate, the closing value of the goodwill should be 8.2. But if we find the balance value here, which is 1.46, that is exchange gain. And this exchange gain will be reported in other comprehensive income. And then it should be distributed between group and NCI. Between group and NCI. So this is how the goodwill is calculated in the group account. So here you have the calculation of the goodwill, exact value. Here they are working in 30 common, and I have done the calculation of the goodwill in terms of millions, in terms of millions. But if we convert them in 30 common, answer would remain Ineffective. Answer would remain ineffective. You got the calculation? Just a minute. Just give me a minute. There's some technical mistake. Okay. Look at here. $24 million, and here we have $6 million. So here we have $30,000. They're converting accordingly. And fair value of the net assets, if we talk about the fair value of the net assets, it was 43,000, 50 million dinar into 2 and plus 15,000. So, and in terms of dollar, it will become 19750. I am doing all the working in 30 comma. So the goodwill was 82,000, and this 82,000 will be converted at the exchange rate at the date of acquisition. And then this goodwill is impaired by 30%. So the closing value of the goodwill should be equals to 57,400 in terms of grommets. And this impairment loss will be translated at the closing rate because this loss occurred at the year end. So in terms of dollar, it is 3514. And according to X21, goodwill will be retranslated using the closing rate. So it is at 200. And here we will be having the exchange gain or exchange loss. And that will be would be 1464. So now we have rounded the values, and these calculations I have done with 30 common working. So this is the calculation of the good. That was the next requirement which we have performed. Now here you can see also the calculation of the good. Got it? And on goodwill, we have exchange gain of 1464, and this gain will be distributed between group and NCI according to their percentage. Now, coming back to the exhibit number 3, in exhibit 3, it is relating to IFRS 9. And in IFRS 9, we have impairment of financial assets. This exhibit relating to that impairment of the financial asset. According to impairment model of IFRS 9, when we recognize the financial asset invested in debt at amortized cost or at fair value through other comprehensive income, on initial recognition, a 12-month expected credit loss should be recognized, which subsequently should be reviewed that whether the chance of default of a customer becomes significant or not. If it becomes significant, you will replace the 12-month expected credit loss with the lifetime expected credit loss model, and we will generate the loss allowance. We will generate the loss allowance, and that loss allowance will be reported in profit and loss account. Okay. So keeping that thing in mind, we now read the exhibit number 3. On 31st December X3, H company purchased 10 million 5% bond in safe company at par. Bond are repayable on 31st December X6 with the effective interest rate of 8%. Their business model is to collect the contractual cash flow. And at December X3, the bond considered to be low risk, and as a result, 12-month expected credit loss is expected to be $10,000. Now, at December X4, S company paid the coupon interest. However, at that date, risk associated with the bonds are deemed to have increased significantly. The present value of the repayment for X5 and to be 462,963 with 3% probability of default. And at December X4, it is also anticipated that no further coupon payment would be received during the year ended December X6, and only the portion of the nominal value of the bond would be repaid. The present value of these cash shortfall assets to be 6558710 with 5% likelihood of default. No accounting entry have been made in respect of the bond since they were required, other than to record the coupon interest received as interest income. Thus, coupon received is recorded as interest income. So, dear student, they have purchased a bond. The bond with 30 common has a carrying value of 10,000. Effective interest rate is 8%, and coupon interest rate is 5%. So the closing value of the financial asset is 10,300. 10,300. And when they purchase this bond, the loss allowance they have recognized at December X3 was 10. But now the loss allowance has become stage 2, and you need to recognize the lifetime expected credit loss. And the lifetime expected credit loss, because the chance of default has become significant, in X5 you expect to receive only 462 point 963, but with 3% chance of default. And similarly, in X6, you expect to receive 6858.710 with 5% chance of default. So the chance of default has been increased. So the loss allowance should be 356.8. So the loss allowance has been increased by 346. Now, the only entry which they have recorded is the coupon interest which they have received. This 500 is just recorded as an income. But the correct thing to be recorded is that interest income should have been recorded as 800 and 300 should be recorded as a part of the financial asset. And uh, they should also recorded the loss allowance expense of 346.8. And in balance sheet, the asset should be presented at the net amount, 10,300 minus the loss allowance. But according to them, they have performed only the one entry, and which is the coupon interest received, which they have recorded as an interest income. And this is the pre-populated spreadsheet which we have to rectify with the error. Now, read the exhibit 4. C company separate financial statement have been translated correctly in line with IS 21, and that give rise to exchange difference of 5.69 million, which is the balance of the foreign exchange reserve. So there is a foreign exchange gain of 5.69, which is included in exchange reserve. Draft balance have been prepared by adding H company and C company asset liability in line by line basis. Goodwill and NCI on rising of C company have been recognized as calculated at the acquisition date. However, the customer contract were ignored as the accountant was unsure how to account for them. No further entry have been made in respect of goodwill. The relevant share of the C company post-tax profit have been correctly allocated to NCI. So, keeping these things in mind, now the next requirement is to prepare the consolidated financial statement. Now, what I have done, I have already transferred these values here. I have already transferred these values here in a statement of financial position, so it would be easy for us to place the value. Now, the first thing we need to perform here is that they didn't included the customer contract, and at the date of acquisition, the customer has 1875 and 657 is the amortization, then 229, they have the exchange exchange gain, exchange gain, 229, and the closing value of the uh, asset was 1428. Now these value we have to adjust in the corresponded balance sheet. Now, the first impact of these adjustments will be that as per their given information, that they haven't considered the customer contract. They have ignored the customer contract while calculating the goodwill. Now, at the date of acquisition, you have a customer contract, and when that customer contract will be recognized at the date of acquisition, your goodwill will be decreased because the net asset will be debited. So if we check the value here in a customer relationship, at the date of acquisition, they were 1875. So with 1875, the goodwill will be credited because you will recognize the uh, assets at the date of acquisition with 1875. So the goodwill will be credited. Goodwill will be credited. And so we recognize the asset at the date of acquisition of 1875. So asset were debited, intangible asset is debited with 1875 and goodwill is credited. But after the recognizing the goodwill, there will be a depreciation as well, which is 675, which will decrease the asset, and 229 exchange gain, which will increase the asset. So at the year end, the customer contract should be valued at 428.57. So that also need to be considered. So I will taking directly the closing value in the intangible assets. So this will become part of the intangible asset. Now the depreciation of 657.7 will be distributed between group and NCI. Now retained earnings are 40245. So 80% of the depreciation will be recorded by debiting the group retained earning with 540.54, and the remaining will be recorded by debiting the NCI by 20%. Similarly, there is a exchange gain as well. There is a exchange gain as well, and that exchange gain need to be reported. Now, exchange gain, as you can see, is 229. Now, in 229, 80% belongs to group, but dear students, 20% belongs to NCI. So the net effect on the NCI will be 89.28. 89.28. Got it? So this is the customer contract list, a contract with customer which the accountant has ignored in their accounting. This we have accounted for. At the date of acquisition, when we will recognize the customer contract intangible asset will be debited and net asset at the date of acquisition will be credited, and as a result, goodwill will decrease. Okay. They have calculated the goodwill, but they ignored the fact of the customer contract. So we need to record only the effect of the customer contract. And then at the year end, the carrying value of the customer contract should be added in the value of the intangible asset. Now, obviously, between 1875 and 1428.6, there is a difference, and that difference is due to depreciation and exchange gain, which would be reported among the group and NCI. 80% of the depreciation to the group retained earning, 80% of the exchange gain to the forex reserve, 20% of the depreciation to the NCI, and 20% of the exchange gain to the NCI. So in NCI, you have 89 net share, which is after considering the share of depreciation and exchange gain. Got it? Any question? Any question? They have recognized the goodwill and NCI at the date of acquisition other than the customer contract list, and no further entries have been made in respect of goodwill. No further entries. That means the impairment on goodwill is not recorded. Entry has not been made. Now, impairment on a goodwill in terms of dollars, we have calculated, and that is 3514. So the goodwill will be credited, and this will be distributed between group and NCI. 80% will be recorded in a group and 20% will be given to NCI. Similarly, there is an exchange gain on a goodwill. Due to the exchange gain, goodwill has been increased. There is exchange gain of 1464. 1464. Now, exchange gain, with exchange gain, goodwill has been debited. 80% will be recorded in forex reserve and 20% share will be given to NCI. So all the entries other than the goodwill recorded at the date of acquisition, all the other entries in a goodwill has been performed. Customer contract, goodwill impairment, and retranslation of the goodwill, and that has been distributed accordingly. Now, there is another adjustment relating to financial assets. Dear student, in financial asset, if you look at the working, they have recorded only 500 interest income, but they should have recorded 800 interest income. It is, and 500 has been received and 300 should have been added in the financial asset. So that 300 is missing. So what you have to do, you have to debit the financial asset by 300 and you have to debit the group retained earnings by 300 by 300. Okay, and the further loss allowance which is not account for is 346.8. 346.8. With that, the financial asset should be credited and group retained earnings should be debited. Now, the interest income of 300 and the loss allowance will only given to group retained earning because it is parent adjustment. So there is no need to distribute it with NCI. That belongs totally to the parent company. And another adjustment, which is the last adjustment, need to be performed. They have translated the C company correctly, but on translation there is exchange gain of 5.69. 5.69. Now 5.69 million means 5690. There is an exchange gain, and that exchange gain is part of the forex reserve, included in a forex reserve. But there is one problem. Uh, this is 5690, 5.69 million. Now the problem with that is that of this 5690, 20% belongs to the NCI. So with that 20%, the forex reserve should be debited and NCI should be credited. Now, all the adjustments have been performed. Now we will find the correct values. First of all, property, plant and equipment. Then intangible asset, financial asset, and goodwill. There is no adjustment in the current assets. So they will be taken same. And the total assets are now 105,742. Similarly, there is no change in a share capital. So it will be 10,000. But the balance of the retained earnings, forex reserve will change. And as a result, the total value of the equity will change. NCI value will change. So the total equity value now will become equals to 5642. there will be no change in the bank loan. It was 30,000, it will be 30,000, and there is no change in our current liabilities, which are 19,200. So the total equivalent liabilities will become 105742. So here you can see that how we have corrected the foreign subsidiary balance sheet. Okay, and we have performed this calculation on the basis of Exhibit 4. The asset and liabilities of the subsidiary were correctly accounted for, but the resulting exchange gain of 5.69 is reported in Forex, and the error in that is that 20% belongs to NCI. Goodwill and NCI at the date of acquisition is calculated accordingly, but only one mistake. One mistake is that they didn't account for the customer contract, which we have now accounted for, and with that we have recorded all the adjustments, and no further entries of the goodwill has been performed, like impairment and exchange gain, which we have performed. Okay. So, and after doing all these things, we have now the corrected statement of financial position. Got it, students? Any question? Okay, now we have another question, and this is again on a question of the foreign subsidiary. Now, first of all, look at the requirements. Using Exhibit 1, discuss what is meant by an entity presentation and functional currency, and explain your answer with reference to how the presentation and functional currency of the B company should be determined. Now, dear student, the presentation currency is the currency uh, in which the financial statements are presented, and it is totally up to the management to decide that in which currency the financial statement will be presented. It totally depends on the shareholder needs. And the functional currency, as we have discussed earlier, is the currency of primary economic environment in which entity operates. And to determine the functional currency, we have a very clear-cut criteria which include primary and secondary factors. Okay, that is the opening remarks of this question. Now, how the B company functional currency and presentation currency should be determined? For that purpose, you first of all you have to read the exhibit number 1, and I would require you kindly read this exhibit. Kindly read the exhibit. Then we will discuss. Kindly read it. So, have you read it? So first of all, again, the B is the bike light is a foreign operation, and in for foreign operation, the first thing you need to consider is that whether the the functional currency of the parent is the functional currency of the subsidiary or not, and the same rule will be applied that whether the subsidiary company is dependent significantly on the parent company or not for sale volume, for financing need, for their decision making. If they are dependent, then both have the same functional currency, and the functional currency of the parent will be the functional currency of the subsidiary, if that is the case. Otherwise, we need to determine the functional currency of the foreign operation. So in case of B, company, uh, the B is doesn't dependent on the Carbice, its parent company, because they are autonomous. Now, how I'm saying they are autonomous, they are deciding that in which currency they would be buying the material, in which currency they would be selling. They are not taking any directions from the subsidiary company. And the revenue with the parent company, the sale volume is not significant. And further, when they need the financing need, the fund raised from an issue of bond in dinars, not in dollar. It tells us that they are not dependent on the car by their parent company for their financing needs. So the functional currency of the bike light is not dollar, is not same as of the parent company. So if not the case, then what is the functional currency? For that purpose, we need to consider first the primary factor, the sale price. Now, if we look at the sale price factor that is split, they sell in different currencies in which they invoice their revenue in dinar, yen, and dollar proportionately in equal proportion. So there is no significant one currency in which we can say they invoice their sale or revenue significantly. So we can't identify the functional currency in terms of revenue. And when it comes to in terms of operating cost, the 40% of the raw material is in dinar and 50% in yen. It is also confusing, but in terms of financing, when they need a financing, they raise their fund in dinar. That is a secondary factor. And their all staff costs and overhead expenses are paid in dinar. So the significant portion which is indicating out of primary and secondary factors, especially the secondary factor regarding the financing need. When they need a finance, they raise the funds in dinar. This is indicating that the dinar should be the functional currency of the bike light company. Dinar should be the functional currency of the bike light company. And I have the written answer as well. Here you have the answer. Now, the requirement was what is the presentation and functional currency. First of all, we need to define it and how the bicep will stack the presentation and functional currency. So the presentation currency is the currency in which financial statement are presented. IS 21 permit an entity to present its individual financial statement in any currency. It would therefore be up to the directors of the B company to choose the presentation currency for its individual financial statements. Factors which could consider include the currency used by the major shareholder and the currency in which debt finance is primarily raised. The functional currency is the currency of private economic environment in which entity operates. Since transactions are initially recorded in an entity functional currency, the result and the financial positions would need to be retranslated where it is different from the presentation currency. When determining the presentation and functional currency of the B, the consideration should first be given to whether the functional currency of the B should be the same as the carbice, at least while under the control of the carbice. It appears that the B has considerable autonomy over its activities, despite being required to make more efficient use of the surplus inventory of carbice. Purchase from carbice were only 5% of the B total purchase. Revenue is invoiced in range of currencies, suggesting a geographically diverse range of customers, which, although this allow carbice access to new international market, is unlikely to be classified as an extension of the parent operation. The volume of the transaction involved between car buys and the B would seem far too low to come to this conclusion. B, the bike light also appear to free to retain cash in range of currencies, to keep the cash in range of currencies, and is not obliged to remit the cash to the car buys in form of dividend. Nor does the bike light appear to be dependent on financing from the car buys with other investors, taking up the bond issue at the start of Act 6. So the functional currency of the B does not need to be same as car buys. In choosing its functional currency, B should consider the following primary factors: the currency. Okay, I will provide you. I will provide you the copy of this document as well. So they should consider primary factor. In primary factor, if you are reading, is the sale price, the sale currency of the sale price. Now they are selling in three currencies, so that was not indicating that what should be the functional currency. Then the second primary factor is the operating cost. Now staff costs are incurring in dinars, but the raw material purchase price is in yen and dollars and dinars. So that is suggesting little bit that the functional currency might be the dinar, but uh, one of the secondary factors, the financing need, is the clear-cut factor which is indicating that the functional currency should be dinar. When they raise the when they issue the bond, they issue the bond in dinar. So considering all these factors, we would be suggesting that dinar should be the functional currency of the bike light company. Okay. And I am going to share this document as well. If you think it could be useful for you, you can use it. Okay. I have shared in a chat box. Now, coming back to the question, requirement B, using Exhibit 2, explain with supporting calculation the goodwill arising on the acquisition of the bike light company and accounting treatment of the subsequent changes, differences on goodwill. So we need to calculate the goodwill, and we have to explain that how goodwill has been calculated and how the exchange differences on goodwill should have been recorded, should have been accounted for. Okay, this is the requirement. And the part C is explain why exchange differences will arise on net. Okay, that is a different part. Okay, focusing only on B, calculation of goodwill and their exchange differences and their accounting. And for that purpose, we have to go through the exhibit number 2. So this is the exhibit number 2. Dear students, first I will recommend you that you people should read it very carefully. Then I will elaborate it. Kindly read it. I'm giving you 5 minutes. Read it very carefully. And one more thing. Using calculator, try to calculate goodwill. Roughly estimate that what should be the goodwill on this foreign subsidiary at the date of acquisition. Okay. Okay, so the Carbis paid 100 million dinar for 80% of the 10 million ordinary shares on 1st January X2. On that date, retained earnings were 70. There were no other reserve. The carrying amount of all assets and liability were equal to the fair value. They measure the NCI at fair value, and the fair value of the NCI was 20 million dinar. Due to technological advancement by the B company competitor, it was decided to impair the goodwill in the B company by 6 million dinar during the year ended 31st December X5. So rates of exchange between dollar and dinar are as follow. On 1st January X2, date of acquisition, 0.5 dinar is equal to $1. Average rate is 0.4. Uh, Closing rate at X5, 0.38, and closing rate at 31st December X6 is 0.35. Now we need to calculate the goodwill, and for the purpose of the calculation of the goodwill, we need to use the spreadsheet. And here we are going to calculate the goodwill. Now goodwill in terms of dinar, exchange rate, and here there will be dollar. So first of all, investment 100 million dinar, value of NCI at the date of acquisition was 22 million dinar. So the total value is 122, and fair value of net asset at acquisition date and the date of acquisition was 1st January X2. That was retail earning was 70, and the share capital was 10 million dinar. So 70 plus 10, it would be 80. So the goodwill will be 80 at the date of acquisition. And the exchange rate, most important thing, exchange rate at the date of acquisition was 0.5 dinar, was 0.5. And goodwill at the date of acquisition will be translated using the rate at the date of acquisition. So in terms of dollar, the goodwill was 84. Now this goodwill has been impaired during 20x5, and the impairment during 20x5 is 6 million dinar. Is 6 million dinar. And to translate this impairment, we will use the average rate of X5, and X5 average rate is 0.4. I am using here average rate because in this question they are telling us goodwill impaired during the year. So anything during the year should be translated using the average rate. So in terms of dollar, it is 15. Now the goodwill at 31st December 20x5 in terms of dinar, it is 36. And this goodwill will be translated using the closing rate at 31st December x5, which is 0.38, 0.38. So in terms of dollar, it should be 94. But here will be the balancing figure, which would be exchange difference. And that exchange difference is 25.73. And it recorded in other comprehensive income. And 80%, we have acquired 80%. 80% belongs to group and 20% belongs to NCR. Then the goodwill at 31st December 20x6. There is no impairment, so it will be 36, but the closing exchange rate is 0.35. So it will be retranslated again at the year end of X6, and 102.875, and again the exchange difference, and this time it will be 8.12 again. Other comprehensive income, 80% belongs to group and 20% belongs to NCR. So this is how goodwill will be accounted for and how we will account for the exchange differences. Got it? Got it, student? Now the part C, explain why exchange differences will arise on the net asset and profit and loss of the B each year and how these presented within the consolidated financial statement. Now, dear student, if you have studied the IS 21, uh, and in the note which I shared yesterday, there was discussion on this topic in IS 21. But I will give you a brief description now. You know that when we translate the balance sheet of the subsidiary, the asset and liabilities are translated using the closing rate, and the net asset at the date of acquisition translated using the historical rate, and the items of the profit and loss, income and expenses are translated using the average rate. Now, using three different rates in the same financial statement will give rise to a exchange difference. which could be a foreign exchange gain or foreign exchange loss, foreign exchange gain and foreign exchange loss. Now, these foreign exchange gain and losses, which we have on translation of the subsidiary financial statement, they are reported in other comprehensive income. They are reported in other comprehensive income. Okay, and on the time of disposal, those exchange and foreign exchange gain and losses which we have recognized in OCI are retranslated to profit and loss account when we dispose of the subsidiary. Now, how those exchange differences we accounted for? For that purpose, we use the following format. We take the subsidiary opening net asset at opening exchange rate and we take the closing net asset of the subsidiary at closing rate, and the difference of the opening and closing net asset is the difference. We account for that difference, and from that difference we take the profit after tax of the subsidiary and we translate it at average rate, and we deduct that from the total difference, and the remaining amount which we get is known as forex gain and forex loss, and that forex gain or loss is reported in other comprehensive income. Okay, and on the time of disposal, these cumulative exchange gain and losses are translated to or retransferred or reclassified to profit and loss account. So that would be the answer of this part C. And this is the answer. Kindly read this answer. On a business combination, goodwill is calculated by comparing the fair value of the consideration plus NCI at the acquisition with the fair value of identifiable net asset at acquisition. By using the fair value method, the NCI using the fair value method, this means the goodwill attributable to NCI is included within overall calculation of goodwill. At each year end, all assets and liabilities are retranslated using the closing rate. Exchange differences arising or retranslation is recorded within equity. Since NCI is made at fair value, the exchange difference would be a portion between 80 and 20%. So whatever the exchange difference is, would be reported between group and NCI with 80 and 20%. Okay, so there will be exchange differences because uh, goodwill we are translating using the closing rate, asset and liabilities we are translated using the closing rate, profit and loss item we are translated using the average rate. So these will create exchange difference in a financial statement of the subsidiary, and those will be reported in other comprehensive income, and they will be distributed between group and NCI with 80 and 20%. And on the time of disposal, those differences will be reported to profit and loss account, will be reported to profit and loss account. So that discussion should be taken place here. Now, using the pre-populated response option with exhibit 3 and your answer to part B. adjust the equity section of the draft consolidated financial position in order to prepare the correct extract at 30th, 31st December X6. Okay, at 31st December X6. Now adjustment which we need to perform here is only for the exchange difference on goodwill relating to 31st December X6. We presuming that X5 is correctly accounted for. Now, dear student, in X6, the exchange difference is 8.12. Now, it's a very simple adjustment. From now, 80% of this will be reported in Forex reserve and 20% of this would be reported to NCR. And the adjusted values will be 95, exchange differences will be 81, and the total value will become 114, and NCA value will become, and the total value of the equity will become 1208.12. So these would be the adjustments. So it was another question on foreign subsidiary, I don't know how much of you have attended the regular class as well, but who have attended the regular class on LMS, there is a lecture available on IS 21. I will recommend you kindly watch that lecture. Okay, that would be covering comprehensively all the aspect of the foreign subsidiary. I would ask the management to share that lecture in the crash course class as well, but the regular student can find it on LMS as well. Okay. Okay, students. Now we will take a break. We will take a break for 20 minutes, and after the break, we will resume the class. Okay, welcome back. Okay, students. Uh, Now we are moving toward consolidated cash flow statement. Okay, now look at your screen. Now, dear student, we have a consolidated cash flow statement. In consolidated cash flow statement, we have operating activity, investment activity, and financing activity. Uh, but one thing we need keep in mind that due to IFRS 18, if you remember that interest payments and dividend payments, uh, can be presented under the operating activity, and we used to present the interest payments and dividend payment under the operating activities. But now just remember that interest payments and dividend payments now can only be presented under the um, of a financing activity. Now they can never be presented under the uh, operating activity. They cannot be presented under the operating activity. Now they can only be presented under the investment, under the financing category of the cash flow statement. So we have a question with the name of Aspire Company. So background, Aspire Company, a listed company, operate many of its activities overseas, and it has interest in number of other companies. Aspire Company functional currency is the dollar. The current financial year end is 30th April 2008. So following are the information. DJ Property Company um, describe the potential investment in DJ Property Company, acquisition of Hope, consist information relating to the acquisition of the Hope Company, further information provide further information about the draft consolidated cash flow statement included in a pre-formatted response option and Exhibit 4, and draft consolidated cash flow statement provide extract of the draft cash flow statement of 30th April 2008. Now first look at these requirements. Using Exhibit 1, prepare explanatory note to discuss whether the acquisition of shares in a DJ property company is a business combination and whether the Aspire company should include DJ property company in consolidation. So we have to discuss that whether the DJ company acquired is the just a minute, just a minute. Okay. Whether the DJ property company considered as a business combination or not. This is a requirement and it is relating to the Exhibit 1. So before we discuss that, we read the exhibit, let me tell you one thing. Let me tell you one. It is an issue of IFRS 3. IFRS 3 is an accounting standard of business combination. Dear student, if you want to consolidate a company, if you want, the parent company want, they need to establish two things. Number one, they need to establish that they have acquired a business. And number two, they have to establish they have a control. Now, if we define the business is a set of integrated activities which is managed with the objective to earn return in a form of profitability, uh, reduction in cost, okay, set of integrated activities, and those activities has the ability to convert input by applying the processes into output. That is the definition of the business, which is given in IFRS 3. So first of all, the company, the thing which we have acquired should meet the definition of the business. If it meets the definition of the business, then we can say, yes, we have acquired a business, we have a business, and then we will establish that whether we have a control or not. Or if anything is missing, whether it is missing the business definition or the control is definition is not matching, is missing, then we cannot consolidate a company. Okay. So keeping that in mind, we will read the exhibit first of all, then we will analyze the situation. So Aspire company is considering acquire 45% interest in an equity share of the DJ property. Remaining 55% share held by the number of individuals, none of whom holds more than 4% share. DJ Property Company is an investment property company that hold high yield properties that it rent out to Aspire company and other companies. It outsources security and maintenance services for the property and employs 3 staff members in a variety of lease management tasks. The properties represent over 85% of the net value of the company. The management of the Aspire company believed that acquiring interest in a DJ property would result in a lower overall cost, better profit for its own business. DJ Property Company currently report under IFRS for SMEs, small and medium enterprises, IFRSs, uh, and the SMEs are not publicly accountable company. So the financial controller of the Aspire company is unsure whether this would cause problem in terms of consolidation. The finance director suggested that it would not be a problem since she believed that the substance of the transaction would be the acquisition of a proportion of the underlying properties, and therefore it would not meet the definition of the business. So according to one of the manager, it is not a business. When they are saying we didn't acquire the DJ business, we acquired the properties. We acquired the properties because when we say we acquire a DJ property, basically we have acquired properties, not the business. In her opinion, so if it is not a business, so there will be no business combination. He has also said that even if the transaction were a business combination, there is no need to consolidate the subsidiary as it operates in the different industry. Now, first of all, you need to establish the business, okay, whether it is a business or not. Let's say we establish it that it's a business, then we need to establish whether we have a control. And if we establish that yes, we have a control, then dear student, you must consolidate it. Then there is no exemption. The excuse that the DJ property has a different business, they have different operation, cannot give us the excuse not to consolidate, provided that we have acquired a business and we have a control. So, first of all, we need to establish that whether we have acquired a business or not. Now, look at here. First of all, we need to clear that what is a business? What is a business? According to finance director has suggested that substance of the transaction would be the purchase of the share of underlying properties rather than purchase of the share of the business. Now, that is a point of view of the financial director. But as per IFRS 3 indicate that this may be the case if substantially all of the fair value of the gross asset acquired is concentrated in a group of similar identifiable assets. However, that is not the case since the property represents only 85% of the net assets. Okay, first of all, a business is set of integrated activities which has input, processes, and outputs. And you manage those activities in order to generate the return. Now, there is another, that is the definition of a business. But there is another test to identify the business, and that test is known as screening test. According to screening test, if the consideration you have paid to acquire a business, if that consideration is substantially representing the fair value of similar assets or group of assets, then you haven't acquired the business. You have acquired the asset. You haven't acquired the business. Now, here substantially mean almost 100%. Okay. Now here the consideration you have paid is representing 85, the total value of the business. If the total value of the DJ property is $100, in that $100, $85 is representing the value of the property and remaining $15 representing the other aspect of the DJ property. So the price which we have paid does not concentrate substantially into the single asset or group of assets. So that would not be the case here. So the screening test is as passed, that we have the consideration we have paid does not concentrate into significantly into a single group of assets. Okay. So since the consideration test is not met, the definition of business must be considered. Now we will consider the definition of business. Now the business is a set of integrated activities and the asset that is capable of being managed in order to produce output. In other words, the business has input substantive processes together and are capable of being produced output. DJ property has input in form of property themselves, ability to obtain access to the tenants. It has operational processes being the lease management activities conducted by staff, identification of the tenant, letting of the property to them, and collection of rent. And it has output being rental income generated. So we can say that DJ property is a business, not an asset. So the finance director's suggestion is not appropriate. We have acquired the business, not the asset. Yes, but let me tell you, if the consideration paid, we have paid to acquire the DJ property. If the consideration is representing, let's say, 100% value of the property, then we would not apply the definition of the business. Okay, because in that case, in a screening test, it was suggested, if that is the case, that we have paid amount is representing 100% value of the property. In that case, I haven't acquired a business, I have acquired the properties. Okay. In that case, there is no need to apply the definition of the business. The story will be closed on that point. But here, this is not the case. So we apply the definition of the business. Business has a set of integrated activities which has input, which is a property here, processes. They have a management staff who conduct the leasing arrangements, and output is a rental income. So DJ property is a business. So we have acquired a business. Now the second thing we need to establish here, that whether we have a control or not. Now we have discussed that control yesterday. The control means power, exposure to variable return, and you have the ability to use that power. And normally the control can be through more than 50% shareholding. That would be the presumed control or the management contract, or in the absence of 50% or management contracts, management agreements, which give you the controlling right, you need to consider the other factor as well. Like here we have 45% shareholding and other shareholder does not hold on individual basis more than 4% and they are unrelated, they are not related to each other. So it gives us the minority control over that company. So we can say that Aspire company has the control over the DJ property. So Aspire would control the DJ property if it has power over the DJ property, exposure or right to variable return from its involvement with the company, and the ability to use its power to direct the returns. Variable returns are evident from the rental cost saving, the potential with dividend, whether the control exists, therefore hangs on the existence of power. Power will exist if Aspire has the current ability to direct the relevant activities of the DJ property. Power arises from right, including voting right and other contractual rights. Here, there is no evidence of the separate contractual arrangement between Aspire and DJ property, and an assessment of the power is therefore based on a potential shareholding. Although the majority share would not be purchased in a proposed transaction, this doesn't mean that Aspire could not achieve the power over the DJ property. It could, for example, for example, enter into a contractual arrangement with another shareholder in order to obtain their voting and achieve the majority vote. Even without such arrangement, it may be the case that Aspire would have the practical current ability to direct the relevant activities of the DJ property due to relative size of the shareholding in comparison to those other shareholders, none of whom more than 4%. In this case, insufficient information, there is insufficient information to reach the firm conclusion as to whether the control exists and further information is required. So, but technically speaking, they have the ability. So we can say that they have a control. Requirement to consolidate. Now, if we conclude that they have the control, if we conclude this that they have a control, then it must be consolidated. There is no exemption from the consolidation. Okay. And if we conclude that we does not have a control, then obviously, if we does not have the control, then there is no need to consolidation. There is no need of consolidation if we conclude that we does not have that control. Okay. In that case, it would be treated as an associate. So that would be the test of definition of the business and the control. Now, and it was of 6 months. Now, part 2 is advise the management of the aspire company of potential problem arising from application of IFRS for SME standard. If DJ company is consolidated, we should refer to relevant difference between full IFRS accounting standard and IFRS for SMEs. Now, it is a specific issue which is relating to small and medium enterprises. Dear student, let me tell you one thing, then we will read out the things which are discussed here. The accounting standards which we study, they are for not small and medium enterprises. These are basically for the large companies, which are listed company, which are publicly listed company. They are accountable to public. The problem with the SMEs is that they are not accountable to public. There is no statutory audit requirement. So the IFRS which we study are normally not for or not applicable for SMEs due to number of reasons, because compliance cost and complications due to the complication of standard, the SME is often discouraged to apply the IFRS. Okay, so they have their own generally accepted accounting principles, or they have their own accounting treatment, and it creates obviously a problem for the aspire company when they acquire the DJ company property and they are not using those IFRSs which the aspire company would be using. So it would create a problem. There will be differences in the accounting treatment of the DJ property and the aspire company on the same transaction. Normally, the IFRSs which we use for SMEs are basically you can say made some relaxation. If an SME want to use the, let's say, I-16, then there will be some relaxation, like for example, in I-16 revaluation gain or recording in other comprehensive income might be for SMEs. We allow them to record in profit and loss account, and many other areas. For example, in I-23 borrowing cost, we capitalize the borrowing cost on a qualifying asset, but for SMEs, we may allow them to encourage them that they should follow the I-23 or standard, allow them to expense out. So obviously there will be the differences, and it would be challenging for the aspire company when they will consolidate it, because in consolidated financial statement, as we have studied yesterday, that a single set of accounting policies will be applicable. And if Aspire is a listed company, is a public company, then they have to apply the full accounting standard without any relaxation. And when they will do it, obviously they have to redraft the financial statement of the DJ property, which could be challenging for them. So these points we will be discussing here in this area, that what challenges you can face when you are talking about a company to consolidate which is not using or following the full accounting standard, but their own accounting treatments, their own accounting generally accepted principles, or if they are facing the following the accounting standard, they are not in a true sense are being followed. Okay, so now I would advise you that kindly kindly read the highlighted area. Uh, when will the recording for the two live sessions be uploaded? I think soon. I think by tomorrow it should be available. By tomorrow it should be available. But I will ask the management. They do it as soon as possible. But I think it would be available on Monday. So DJ property currently report under the IFRS for SME standard, which is based on full IFRS accounting standard, but with reduced disclosure. It does not cover certain topics of accounting, generally those that are not relevant to unlisted entities. In addition, it removes the certain accounting options and simplifies the recognition and measurement requirements. For purpose of consolidation, DJ would be required to adopt the same accounting policies as Aspire as required by IFRS 10. Therefore, it could either adopt the full IFRS accounting standard in its own statutory account, or it could prepare consolidation pack using accounting policies from full IFRS accounting standard in line with those of group. The latter approach would require two sets of accounts to be produced, whereas the first would add complexity to the preparation of the financial statement. Therefore, either approach has disadvantages. Continued use of the IFRS for SME standard may cause an issue since investment property in one area in which it differ from full IFRS accounting standard. IS 40 allow a choice in applying either the cost model or fair value model. This choice must be made for the whole class of the asset on a consistent basis. It is unclear what Aspire policy is and indeed whether it is currently hold investment property. The IFRS for SME standard require that investment property is measured at fair value as long as this can be measured reliably without undue cost or effort on ongoing basis. Otherwise, the cost model will apply. The accounting treatment for borrowing costs may also be relevant, particularly if DJ property develops its own property or take period time to get them ready to let out. Full IFRS of I-23 require that borrowing costs are recognized as part of the cost of the asset in case of qualifying asset. But for SMEs, they will allow to expense out. A number of other differences exist between IFRS for SMEs standard and full IFRS accounting standard. However, it is unclear whether they would be relevant to Aspire company and DJ property. So these are the challenges, these are the differences which we have, and it would cause problem for the Aspire company, depending on that which accounting standards are relevant for the Aspire company and the DJ property. Now, the requirement B, discuss how the goodwill arising on the acquisition of the Hope and fair value adjustment in a consolidated financial statement should be dealt with for the year ended 30th April 2008 and future year. So, the acquisition of the Hope company. On 30th April X7, Aspire company purchased 70% interest in a Hope company, a multinational company with functional currency of dinar. Exchange rate on the date on that date of acquisition was $1.5 dinar. Purchase consideration was $200 million plus 1 million transaction fee. At acquisition date, the carrying amount of the net asset in a Hope company financial statement was 100 million dinar, including the cash balance of 5.4 million dinar. So, in financial statement, when they acquired the Hope, carrying amount of the net asset was 1000 million dinar, and in that 5.4 million dinar was the cash. And fair value of the net asset is 1100 dinar, and the fair value of the NCI was 250 million dinar. And Aspire company measured the NCI at fair value. And at 30th April, the exchange rate is 6 dinar per dollar. So, how the goodwill should have been calculated? Look at here. For that purpose, if we use the Excel sheet, investment in dinar, rate, and dollar. So in dollars, we have 200 and exchange rate was 5 dinar per dollar. So in terms of dinar, the value of the investment was 1000. And value of the NCI at the date of acquisition was 250 million dinar, and exchange rate is 5. So 250 divided by 5, and the in terms of dinar it will be 1250. In terms of dollars it would be 250, and less fair value of net asset at acquisition date, and that is 1100. And the date of acquisition exchange rate was 5, so 220. So the goodwill at acquisition is 150, and in terms of dollar it is $30. But now the carry forward value at 30th April, let's say, there is no impairment, so it will be 150, but the closing exchange rate is 6. So Closing goodwill is become 25, and they have the exchange loss of 5, which should be reported in other comprehensive income. So it obviously distribution between group and NCI, depending upon the percentage of holding. 70%, so 70% to group and 30% to NCI. So this is how the goodwill should have been calculated. Now, in dinar, it is 150, and translated at the year-end rate, it would be 25. And on acquisition, that was 30, so there is a loss of 5 that need to be distributed between group and NCI. Now, the last part is the using the pre-populated spreadsheet response option with Exhibit 2 and 3, update the draft extract of the consolidated statement of cash flow to adjust the acquisition of Hope Company shares and to amend for any errors, omission made by the accountant. Now, further information. A temporary accountant has prepared the draft consolidated cash flow and is unable to reconcile the calculated net cash flow to the difference between the balance of cash and cash equivalent in a consolidated statement of financial position at 30th April X7 and 30th April X8. The temporary accountant has noted the following. Hope Company has not been included in the draft consolidated financial statement used to prepare the draft statement of cash flow, as the accountant was unsure how to translate the dinar into dollars. The only accounting entry made in respect of the investment is to record the total amount of 201 million as an exceptional expense in operating profit. Okay, now, first of all, they have recorded 201 as an operational expense rather than it's an investment category in which investment should be debited and cash should be credited. Now, what you have to do is you have to adjust that amount in 449. You have to add it back 201, and you have to adjust this 201 in investment category. But keep in mind, when you acquire the subsidiary company, that subsidiary company has the cash balance with them, and which was 5.4 million dinar. And if you translate it at the exchange rate at the date of acquisition at the $5 rate, that would be considered as a cash inflow, and that would be considered when we are taking this cash outflow of 201 in the investment category of the profit and in the cash flow statement. So look at here. Let me show you. Look, they have added the 200 back in operating profit. Now, above it was mentioned 201. They have treated 201 as an expense. Now, in a individual financial statement, this 201 is an investment category. But dear student, in 201, 200 is the investment and 1 is the transaction cost. Now, in a group account, transaction cost should be treated as an expense. So when they have treated 201 as an operating expense, so incidentally, they have recorded the 1 million transaction cost as an expense. That was the correct treatment. So that does not need to be adjusted. So 200 will be added back, as you can see here. It has been added back and in an operating profit, and it will be taken as an outflow here in investment category. Payment to acquired subsidiary of the Hope Company, but it is 199.1. Now, what is the story of this 199.1? Dear student, when you acquire the subsidiary company, Hope Company, they have 5.4 million dinar cash in hand. And on that date, The exchange rate was 5 dinar. So if we divide the 5.4 divided by 5, what will be the answer? Or just a minute, or not 5, because at the year end, the exchange rate is 6. So 5.4 divided by 6. What will be the amount of cash in terms of dollar? Can you tell me 5.4 divided by 6? Exchange rate at the year end. 5.4 divided by 6. It is 0.9. It is 0.9. So 0.9 is the cash from the subsidy. So you have paid 200 and you have 0.9 from the subsidy. So your net outflow will be 199.1. So that is the story of this investment in subsidy. Got it? Yes, student. You got this? Okay. One another thing which I would like to identify. Look at here. Dividend paid 327. They have shown this 327 in operating category. Now, in previously, before IFRS 18, dividend paid can and interest paid can be shown under the operating activity in a cash flow statement. But now they must be shown under the financing activity. They must be shown under the financing activity. Number one, that is the direct point, obvious point here. So it will be taken from financing. Increase in inventory, decrease, okay. Decrease in receivable. Dear student, decrease in receivable, we add. But what they have done, they have minus. Decrease in payable, they have minus, that is correct. But decrease in receivable should have been added. So if we consider these two things and we look at the solution, look at here, what they have done, they have taken it as a positive value. Decrease in receivable should have been added, not minus. So they have converted into plus. By adding 64, they achieved 32. And look at here, the dividend paid, they have reversed from the operating activity. And let me show you that where dividend paid they have shown. Come to the financing activity. You can see here 329. 327 is eliminated from operating and 329 is included in a financing. This 329 includes the 327 as well, and there might be some error of 2 which will be discussed above. When they included it, it becomes 329. But point to be noted here, Now from onward, dividend payments and interest payments should be shown under the financing category, not under the operating category. Now, point number two, a 40% interest in steel company was acquired on 1st January at 7 for 72 million. It is investment in associate which they have done on 1st January at 7. Okay. The investment associate had the carrying amount of 79 million in a consolidated financial position at 30th April at 7 and 81 million at exit. The amount reported in a draft consolidated cash flow statement as a cash inflow is equal to the amount recognized as an income in a profit and loss for the year ended 30th April exit. Steel company had no other comprehensive income. Now the problem is that they have an associate company. The balance brought forward was 81 and the carry forward value of the associate, the closing value is 81 and the opening value is 79 is 79 and in a cash flow statement in investment category they have shown a 6 million, but this is not a cash. This is the income from associate. Share of profit 6 and this is not a cash inflow. This is not a cash inflow. Now, and one more thing, if it is a profit, then obviously it is also part of the operating profit as well. That need to be adjusted there as well. Need to reverse. Now, the amount which should have been shown in investment activity relating to this associate company is the dividend received. And the dividend received from associate is 79 plus 6 is 84. So $3 is the dividend received. $3 should have been shown in the investment category, not the 6. Now, how we will adjust this thing here? Investment income, just a minute. The opening value of the associate was 79. Okay, 6. And the closing is 81. So 85. Okay, 4. Okay, 4 dividend. Dividend is 4. 79 plus 6. The closing value should be 85, but it is 81. So $4 dividend has been received. So this $4 should be shown under the investment category. But what they have shown? They have shown the income of 6. So 2 will be eliminated and here you have the $4 dividend received. So this investment in associate is also adjusted, rectified here. Dividend received is shown under the investment activity. Now coming back to the other information, point number 3. On X6, Aspire company made a 10 million loan to a subsidiary Grace. The loan carry interest 4%. However, this has not been eliminated in preparation of the consolidated financial statement. And G pays all interest due in a year to which it relates. G pays the interest and the parent company receives the interest and that would be 10 million into 4, that would be 0.4 million. Now, intra-group interest income or expense, we eliminate, we do not consolidate it. Now, What would be the impact? The parent company has received the interest, so they have shown it as a receipt under the investment category. And subsidiary company has paid the interest, so they have shown under the financing activity. Now that need to be eliminated. So interest received will be eliminated from investment and interest paid eliminated from financing. Because the parent and subsidiary are treated as a single economic entity, so they intra-group cash inflows, outflows cannot be consolidated. Similarly, as the cash intra-group income and expenses are not consolidated. So that point has been adjusted intra-group interest. And now after that point, the point number 4, Aspire required 75% shareholding in R since X2. On 31st October X7, it sold 10% holding to unrelated party for 14 million. At this date, net asset of the R has adjusted for consolidation purpose were 120. Aspire accounted for the disposal correctly in a draft consolidated financial position. However, it has not included it in the draft consolidated cash flow statement. So they have disposed some of the holding for 14 million, and this 14 million should have been shown under the investment category as a sale proceed, which they haven't considered. So you will consider it, as you can see, you have added under the investment category. So this point has also been adjusted. And now the second last point, dividend paid in a draft consolidated cash flow statement have been calculated as a difference between retained earning at 30th April X7, retained earning balance at 30th April 71690, and those at 30th April X8 1710, brought forward and carry forward. Adjusted for the draft profit for the year allocated to the owner, which was 347. Aspire company has no other reserve with the exception of the foreign currency exchange reserve. So, and the none of the Aspire company subsidiary paid the dividend. So with these differences, they have calculated the dividend payment. So if I use the calculator, maybe you will find something. 1690 were the opening retained earning, 347 is the profit for the year, and 1710 for the closing retained earnings. So the dividend paid should have been 327. It should have been 327, and it is 327 which they have reported here in dividend paid section. So what point they are trying to make? Dividend paid opening. Okay, just a minute. One thing. In the calculation of the goodwill, there is a 5 and 5 5 into 70. Yes, there might be some. Okay, now look at here. Now here they have minus 329. Now 329. And that need to be a spar disposal of a subsidiary. Profit for the year 347 and they are adding 200. Now, from where this 200 has come? They have disposed of. Okay. Just a minute, just a minute. The balance brought forward retained earning were 1690 and closing balance of the retained earning were 1710. The profit after tax they have considered of the group share is 347. Okay, and they have disposed a subsidiary as well. And with the disposal of the subsidiary, there will be they have disposed a 10% holding. Yes, 14 million. Yes, they have disposed a subsidiary for 14 million, and the share they have disposed is 12. So there is a gain on disposal. It is a transaction between owner. This gain should also have been reported here. Yes, this too should also have been reported here, which they have missed. Now, if you consider this too, now you will get your dividend payment of 329. This is a gain of 2 million on transaction between owner. Transaction between owner means you dispose some holding, but you didn't lose the control. So you will the gain or loss will be calculated. The WNT would be bank will be debited with 14, NCI will be credited with 12, and the difference is the gain or loss, and that would be reported in retainer. They have missed that gain. That need to be reported. Now, if you consider this two in your retained earning account, you can see you have a dividend payment of 329 here. So that's why in consolidated cash flow statement, they have taken 329 here. You got it? And after doing all these adjustments, they have now adjusted consolidated cash flow statement. Adjusted consolidated cash flow statement. Got it? Yes, students. Any question? Okay. Now, I have shared the volume 3 with you guys. Now, what you have to do? You need to read all the volume 3 now. from page number 1 to the last page. Kindly read everything in a volume 3, which I have given you in the last class. And after, and I'm giving you a task in these 2, 3 days, because our next class, I think, on Wednesday, I'm giving you some questions which you people should do practice uh, to prepare your question number 1. Now, in a coming class, my focus will be on question 2, 3, and 4. Question 2, 3, and 4, I will be focusing in a coming classes. So now what you have to you have to do some practice question, and I'm giving you some practice question. Like here, question number 1 from the ACCA Study Hub. This is a Ruby company. Kindly note, this is your practice question. It is on consolidated statement of financial position. आशंति को आशंति को it would be your second question. These two questions are your homework, okay? And these are the two questions. And you people should do practice these two questions at least before the next class. But before attempting these questions, kindly go through the volume 3 notes which I have provided you yesterday. Okay? Go through the notes and attempt these two questions. Got it? Okay, students. Okay, students. Now I will see you in the next class, and in the coming classes, my focus will be on question 2, question 3, and question 4. Okay? And in the practice question, we will revise the topics as well. Okay, I will just a minute. I think this is the, I'll share with you. Okay, just a minute. Keep online. I have shared the file in a chat box. Kindly download. Okay, students, goodbye and take care. See you in the next class. In the next class.